Now to tell us more about what's been making headlines in finance and economic news this week, we're talking to Suzanne Haddan from BFG Financial Services. Suzanne, good morning to you.
Good morning.
We might start at home because we saw the RBA release its financial stability report throughout the week. What did it tell us and what did it warn about, more importantly?
Well, from a global perspective, it had the normal warnings we've been used to last year, the trade tensions, the slowdown in China, but it did emphasise another one, which is cyber attacks. That's an increasing risk for the global economy.
And what did it have to say about property prices?
Well, it certainly acknowledged what we already know, that in many areas property has dramatically reduced. It felt that borrowers would be able to cope with their debt levels because it's extraordinarily high, so long as we still have low interest rates and low unemployment. They did highlight that there is negative equity, and that means your property is worth less than you owe. Now, although it's about 3% across Australia, in WA and Northern Territory, it's 13%, which is very high. Plus, people have been putting extra repayments in their loans. Say 2015, about 3.5% of extra repayments across the loan book. That's reduced to 1.5%. So you can kind of see those concerning headwinds of people managing their household budgets.
So what are the ramifications of negative equity, as you said, when your house is worth less than your mortgage? Does that set the tone, I guess, for bank repossessions?
The first thing is, so long as you can cope with your loan repayment and don't have to sell, ride it out. But it's a psychological effect. We still have that issue with consumer spending, and if you feel poorer, you're going to want to park some of your money and not be out there spending, which is probably a good strategy just in case you have to sell. So you could see more repossessions, but I only think if people lose their jobs, that would be the main, or interest rates shoot up quickly, which...
And neither of those scenarios are really likely at this stage?
No, well, we're sitting at around 4.9% unemployment. The perennial problem seems to be wage growth because we're not getting that extra wage increase above inflation to get us a little bit ahead with our debt, and that permeates across Australia still.
Are we seeing more of that negative equity because of the interest-only loans that were given out, particularly before the Royal Commission cracked down on that?
The interest-only loans, I've never been a believer that you should have one of those for your home loan. Different for investments. Now this year, about $120 billion of loans are coming off interest-only. And that can mean about a 40% increase in your repayments. So let's say you're captured with principal and interest repayment changes and you're in negative equity and you're forced to sell. You still owe money and you've got no asset. That's a huge problem.
How many of those interest-only loans that are maturing and will be moved over into principal and interest repayments are there? You mentioned the actual sum amount, but do you know how many households that might affect?
Well, it's about 7% of the loan book.
Right.
So it's still fairly significant. What's changed, though, is we go back a couple of years that government regulator APRA reduced banks to be able to do interest-only loans. They've lifted that limitation, so maybe more people can stay on interest-only. Not always a good idea, but if it gets you through a difficult time, that's a good outcome.
And are we seeing banks be more careful about giving out their loans and being... I mean, we are seeing that after the Royal Commission, certainly.
Absolutely, and it's not just the Royal Commission. Responsible lending has been a theme from APRA for quite a while. What you're seeing, there's new comprehensive reporting, and so when you go for a loan, a financial institution has a lot more information available and can pick out those porky pies people tell on their applications. The big one is credit cards. Now what happens if you've got a credit card and owe nothing on it, but it's got a limit of $10,000, they have to assume that you are paying off $10,000 over 3 years. So what's my tip here? Get organised. If you're going for a loan, look at your credit card statements, look at your spending habits to work out what the banks will, and other institutions will be looking at. We've spoken before about financial hygiene. Just say, oh, I'm going for a loan, nothing needs to change here. You need to get your act in.
So amalgamate all your credit cards just into one with a lower threshold?
Absolutely.
Okay.
Check your spending, because you might have a one-off expense and say, oh, now's the time to get a new couch. No,
Right.
now's not the time to get the new couch.
Yes.
You want to have a very clean record.
Okay, and on the housing market in general, I mean, we've seen CBA reduce rates, and they're up to, I think, 40 lenders this year have reduced their mortgage rates. Is that a reflection of how dire the housing market is?
Well, there's a couple of things there. We're normally used to out-of-cycle interest rate increases. That's where the Reserve Bank doesn't change, to go up. To have them go down, that's telling us they're not getting the number of loan applications, so competition is increasing. Lending is down, and so they have to do something to attract the borrowers. One of the other things, it's only what we're hearing is some of the banks are trying to make it a little easier to apply for a loan.
We also had some interesting comments from the former Treasurer, Peter Costello, this week about self-managed super funds. What did he have to say?
Well, he's highlighting what I certainly believe in. They're certainly not for everyone. If you want to invest in property, maybe you're a small business person, if you want to invest in art and collectibles, if you are simply a control freak, you would probably look at a self-managed super fund. The problem is they're not without their risks. You can have great skill, but you might not have the time or the interest to run your self-managed super fund. Another factor is people forget self-managed super funds are here and we have the rest. Self-managed super funds do not have fraud protection from the government, where all other super funds do.
And you have to have a, just before we finish this off, Suzanne, I mean, for it to make sense, because it needs to be audited every year, you should have a critical mass there. Is it $500,000 in your super before it makes sense to have an SMSF?
That's sort of the rule of thumb for a volume, but even if you've got $500,000, it can still not make sense.
Right, okay.
Suzanne, we'll have to leave it there. Thanks for coming in this morning.
Thank you.